All right, you guys, we are recording. One thing I mentioned at the beginning of every single webinar, like a broken record. Watch this again, maybe not even just this particular poor man's covered put. We are going to be trying to talk a little bit more specifically about a full-on portfolio here. If you guys have been following along here, I've been implementing strategies into my platform in order to create a portfolio, and we're doing that through all of these option strategies. So follow along with that. Also, with the poor man's covered put, some of you might be saying we are at all-time highs. The market is in a bullish move right now. Why would I want to put on something bearish? Well, at the end of the day, there's always a bearish market out there in something somewhere. It could be the retailers, for instance. Some of those retailers didn't have a very good season, and we might start seeing those guys correct a little bit. That's not necessarily going to pull down the whole market. We could still continue to see highs happening. We saw it with Boeing, right? Boeing was going down, and we're still seeing the Dow go up, although Boeing accounts for a lot of the market movement in the Dow Jones Industrial Average. All right. So this is on the poor man's covered put. We will be able to find something, believe it or not, that we can implement this strategy in and around the markets these days. All right, but let me get a couple things out of the way real quick. My name's Eric Wilkinson, and you may recognize me from mainstream media as the Wolfman, where I've talked about everything from economic to geopolitical and market analysis. I actually started trading in college with a psychology degree, and decided to switch over to finance. After graduating from college, I moved straight to Chicago and started working on the floor of the Board of Trade. So I've been trading stocks, bonds, financial futures, commodities, currencies, and options on all these products in just about all market conditions. Please remember that we got to go over this disclaimer really quick. This is an educational webinar, you guys. I'm not here to give you investment advice. The reason is I don't know what your risk parameters are. I don't know what's in your portfolio. I couldn't possibly be fiduciarily responsible for by giving you investment advice at this point, okay? There's a lot that goes into giving investment advice, and I'm not here to do that in a webinar. I just couldn't possibly get through all of it. We would be here for days, actually. So just remember, this is general education material. And everything that I talk about in this webinar is general commentary and does not constitute investment advice or solicitation to buy or sell any contracts or any of these products, okay? I might even be talking about strategies or underlyings that I have in my portfolio. I'm not trying to get you guys to do the same thing, because you might very well have an opposite opinion than me. And that opinion might very well be right. All right, so bottom line is, do your own homework, and please remember, past performance of any trading system or methodology is not necessarily indicative of future results. All right, you can follow me on Twitter at Wolfman's Blog. Our parent company is at ProTraderStrat. So all kinds of market wisdom, and ProTraderStrat will be pushing out a lot of promos and stuff like that you can take advantage of. We've been putting out a lot of the videos that I do, daily market commentaries and webinars and stuff like that, on Facebook at ProTraderStrat. We also have a ProTraderStrategies.com is the easiest way really to look for it on Facebook. And the same on YouTube. I don't have a YouTube link up here, but ProTrader Strategies is the easiest way to find us on YouTube. That has all of the archived videos, or a lot of archive videos. They're not in any particular order, you guys. They're all over the place on YouTube. The best way to get those in a logical formation is really on our website, which is ProTraderStrategies.com. So take advantage of that. All right. So we're going to be talking about building a poor man's covered put, and we're going to be talking about a little bit more about how to implement that, when we would want to add something like this. And right now is a great question for that. Couple of things to get out of the way, though. It is not a diagonal spread or covered puts on leap, or it is a diagonal spread and covered puts on leaps. The problem is I was thinking we are going to be doing leaps. Now, generally speaking, leaps are, long-term anticipated securities. I don't like to go out, 2 years, which is what this is really saying, is 2 years, 1.5 to 2 years out. That's pretty far out for me on a trading strategy where I think that there's going to be a correction in something. So I like to usually go a little bit closer, and it can still be considered leaps, but I'm looking at, 90 to, 150 days-ish, days to expiration on the option. So I'm a little bit tighter on this, but generally when you go online, if you were to look at it on Investopedia or something like that, they're going to be telling you to use these way out here. And to me, the risk reward on building that out doesn't really work out very well. And I'll go through all of the reasons why that we wouldn't want to really do that as we pull up the platform and stuff like that. And it's not a calendar spread, you guys, because a calendar spread, we'd be using the same strikes, and we're not going to do that. All right. It is a bearish strategy. Now, I say slightly. If you are super bearish, this is one where we're going to kind of want the market to kind of trickle off, all right? But if you think the market is going to do one of those nosedives, then there's better strategies out there for that type of move. This is something where it is just in a bearish pattern. You were seeing, the typical lower highs and lower lows consistently going down, and we expect it to kind of stay in this like little bit of a trend channel. Okay, we don't want it to break out and just slam down. At least not right away in the next couple of days. If it happens, in about a week or so, then we're all right with it. But the fact of the matter is you'll be paid off a little bit better if it happens over the course of time. One reason is because the short puts will be able to be rolled out again and again and again and continue to collect credits on those. That's the best way to build out this strategy, is when you can continuously roll out those puts and lower your basis on what this trade is. Now, if it does take off and blast through your short puts, well, those are great problems to have, right? You met your objective, you made your profit, and you're able to walk away with some money in your pocket. So it's not a terrible thing. It's just the best case scenario, because we expect a long-term trend, would be to have it kind of trickle off, really, is best case scenario. Now, when we're looking at the poor man's covered put, our max profit is really the width of the strikes minus that debit paid. And we're going to build this out so that we're going to try and shoot for about 75% the width. We want it to be less than 75% the width of the strikes, okay? Our debit paid. We want our debit to be less than 75% the width of the strikes, okay? That's going to be the big green light. That is the wheelhouse we're looking for. Can anybody else have volume? I think David's saying that he has no volume. Did we lose volume? It looks like on my end I'm getting volume. So if you could hit me up in the questions box, if you can hear me. David, you have volume. Is that what you're saying? Can hear clearly. Okay. Let me try and send this gentleman. All right, good volume. Okay. All right, let's see if you can get that. All right. So, all right. Now, if it is something like, between 75, and this is kind of a ballpark, if it's like 75% the width of the strikes, and I'll show you how to go through to 85%, that's usually like a yellow light. So that's kind of like a gray area, all right? Anything more than 85%, you guys, just walk away from it. There's better strategies out there. You might want to just go out and do like the synthetic short. So take a look at that webinar. Make sure you know the rules on that as well. So if it's like greater than 75%, I usually just walk away. There's better opportunities out there. All right, the max loss is the debit paid. That's the beauty in this strategy, is we have a debit, and 90%, 99% of the time, whenever you pay a debit with a strategy, that's your max loss. And with that debit paid, the reason why I'm talking about this a little bit more is that, and I wanted that market to kind of trickle down like that, is because we can continuously roll these short puts out there and reduce that debit paid. We can reduce our max loss. We reduce our basis on this trade. And that is ultimately, if you are especially a long-term bear on the underlying, if you can continuously roll out those puts and lower what you paid for this strategy, it increases your probability of success. It'll also make that spread profit a little bit better as well. All right, now we're going to have a break even on this. And, you know, our max profit on this, you know, it's assuming that the width of the strike stayed intact in that first month, those short puts. But, you know, if you took off the short puts after a couple of months, then, you know, your max profit can be a little bit different. But our break even is the long put strike minus the debit paid. So what we want to do is try to make this break even here. We want this break even to be equal to where that underlying is trading, where XYZ is equal to where XYZ is now trading. So if we can nail that, that is best case scenario. Sometimes it's going to be slightly lower. We're going to be getting into the short, maybe slightly lower. Sometimes you'll be able to get into this where you're getting short this underlying above where this XYZ is trading. And that is the best case scenario if you can have all of these rules that I have come into fruition and all of a sudden you're getting short above where the current market is trading. The short put is the lower strike than the long put, right? Yes. Our long put is going to be in the money, all right? So it's going to be higher, or we're buying our long put higher than where the underlying is trading. And then our short put is going to be lower than where the underlying is trading. And the durations are going to be different, all right? Okay, you switch from mobile to your computer. All right, good enough. All right. So why do we want to use options in the place of shorting or borrowing a stock? There's a lot of things that go into it. One, we're going to be reducing our risk. If you're shorting a stock and doing maybe covered puts on that short stock, you guys, one of the things with this is it's really like we are putting a collar on this underlying. And usually with that, you're limiting your risk as well. But the reduced risk on here is because we're putting up less margin. You know, we don't have as much to lose. The deltas are going to be a little bit different than doing a covered put on this. And reduce capital requirements. Anytime you are shorting a stock, you're going to have to put up a lot more margin for this trade, probably 50% more than what you are, or this strategy is 50% less. And in that case, the funny thing about math is then if you did this strategy versus doing the short stock, then it would be 100% more capital for just shorting the stock with the covered put. So this is a lot less capital intensive, and especially for some of the smaller portfolios, this is great for that because you're able to add more strategies. And if you can add more strategies, you know, you have a lot higher probability of success in your portfolio. And I guess I got a little ahead of myself, creating a more diversified portfolio of securities. If you're using less margin with the same amount of capital in that account, then you can obviously do a lot more with that money. And one of the things is you can have a higher probability of success, which I also talked about. And if we're using less margin on all of this, then our return on capital will be much higher. One of the other advantages is also if you were to go out there and short the stock and build it that way, there is a likelihood that you are going to have to pay the dividend if you are going through that ex-dividend date. All right, you're going to have to pay that dividend for shorting that stock. All right, the disadvantages of this. Some of the disadvantages are going to be you've got to stay active in the options with earnings. One of the disadvantages of setting this strategy up right now is we are heading into earnings season. So we're kind of, it's an advantage and a disadvantage in a sense. I mean, I would rather not have a cover on my directional assumption necessarily during an options because if I'm going through something with an earnings, then, you know, my directional assumption is my directional assumption. So I don't want to limit my my downside in this case with a short put, okay, which will happen. So setting it up, that would be the disadvantage. You're going to go through the earnings cycle likely with that short put, which limits your downside profitability. One of the benefits, though, is that short put is going to be so jacked full of premium because of the volatility that we'll be able to get further away from where the underlying is currently trading as well. But it's still going to have a high probability of being touched. And we'll talk about all that stuff here in a little bit too. All right, the long puts will eventually expire. If you've shorted that underlying, you basically can hold on to that short for a long time. You're going to have to pay maintenance on it and stuff like that, but you are also going to see these options in this strategy expire, whereas the short, typical short, you're going to end up being able to stay in it longer, although you're going to have to pay some fees and stuff like that. All right. Forced assignment on the short put. Yes, if this automatically took off and went below our short put, we could get assigned. All right. Forced assignment on that. One of the beauties is, and this used to be a bigger deal because of the fees involved in assigning and stuff like that. But now that they've lifted the fees, this isn't as big of a deal. Remember, we're buying a put that is in the money, and we're selling a put that is out of the money. So if we get forced assignment on our short put, well, that means that XYZ, we've got a long put way up here and a short put way down here. Well, if the market tanks and goes below here, we could get assigned on these short puts. But, this long put is now way deep in the money. So we can, kick this back to somebody else and assign them on it, and it basically offsets the trade. All right, you're going to be long here, and you're going to still make up that width of the spread minus the debit you paid. Okay, so it seems like it's a bad thing, but it doesn't always work out that way. All right, how do we start building this thing out? All right, one of the things we got to first look at is, do we have the right underlying? Not all options are created equal. What we will see a lot of times is that the options that are trading get a little wide, despite the fact that there might be a lot of volume going on, 13,000 contracts. This isn't going to be a great example of it. But for during open market operations, this is what we want to look at. Closest to 36 days to expiration, okay? Or 35 days to expiration is what I usually say, but I spoke a little bit by reading. We want to look at this, and any stock that's less than $100, we want to make sure these bid offers are less than 10 cents wide. And for a $5 stock, these are really wide markets, to be quite honest. But let's look at a slightly better example. So Budweiser is less than $100 stock. And during open market operations, we look at this because after the close, all of the orders get canceled, at least the savvy people, hopefully like you and me. Don't let these orders run overnight unless you really want to get out. I would just look at it in the morning usually. But less than $100 stock, our rule of thumb here is going to be that we're going to look at this where we look at this less than $100 stock, and we are going to want these to be less than 10 cents wide from the bid to the offer, all right? To the offer, right? And that we look at 35 days to expiration here is the sweet spot for that. And we're just looking at the bid offer on the calls and the puts all the way down and make sure they are inside of less than 10 cents wide to the bid offer. That just tells you there's a lot of volume and open interest going on. There's a lot of eyeballs on this, and that's what we want. Free market price discovery in full swing. That is where you are getting a lot of eyeballs. Now, we are going to be playing out here in some of these further duration months. Remember I said we're going to be buying something 90 to 100 plus days out, 150 some odd days out. But that's not what we're looking for this rule. We're looking for this rule on 36 days to expiration. And it doesn't really matter what option strategy we're looking at. we always look to the 35 days to expiration or the closest to that. You know, sometimes it's 45 days to expiration. That's where we're going to be looking for this rule. And we're going to make sure that it's on a stock less than $100, that it's less than 10 cents wide from the bid to the offer. Now, if it is a stock that is over $100, then what we're going to do here is we're going to move our decimal 3 ticks to the left. So we're going to basically go 1, 2, 3, and now we're looking at 15 cents. So we want it to be equal to or less than 15 cents from the bid offer on these options, 36 days to expiration. So we go down here to the calls and the puts and just check, yeah, if it fits that rule pretty solidly on the ones that are just out of the money. That's where we're kind of looking at this rule. And you can see that when fits that rule. So we would see it most likely in, something like Tesla or something. If I pull up Tesla, it's now a $500 stock, and it will easily fit that rule. So $500, move the decimal 3 ticks to the left. We're looking at 51 cents to the bid offer, and you can see that it's not fitting this rule right now, but during open market operations, it generally speaking is. So that's why we want to do that during open market operations. Same thing with Costco, move it 3 ticks to the left, make sure that they are inside of 30 cents to the bid offer, all right? Everybody clear on that one? So that's making sure we got the right underlying. If it doesn't really fit that rule, I think I'm booking in here. You know, the idea would be, it would be $2 wide. Booking, ever since they switched their ticker from Priceline to Booking, they've gotten really wide markets. So I don't know when that's going to catch up, but hopefully relatively soon, because I used to like to trade Priceline. But that's the rule. So obviously with Booking, if it was during open market operation and I'm looking at these being $5 wide, I would probably not be trading it because the eyeballs just are not there yet. All right. Let me close that out. All right. So picking the right strikes. With this one, we want to make sure that, I talked about this a little bit, less than 75% the width of the strikes, all right? Equal to or less than. So right around there is the sweet spot. That's like your green light. So basically, if you're paying $7.50, if you pay a $7.50 debit on this spread and it's $10 wide, well, that would be what we're looking for, all right? $10 wide spread, you pay a $7.50 spread, that fits that rule. So that is a green light. If it's like 85, 75 to 85%, in that 80+%, that's a yellow light. And the reason why I say that is you have to make sure that this is going in your right direction, because I don't feel like the risk reward is there for you, all right? With this type of strategy, we want to be paying as little as we can to get this to work out. And if you're paying less than 75% the width of the strikes, it usually means that your short put is much further away from where the underlying is trading as well, all right? So we want to keep that in mind too. All right, so we're selling that near term out of the money strike. This one, we're going to be looking here. This one's going to end up being about a 25 delta strike when we're selling that near term. And then the one that we're looking at that is the out of the money, we just want to make sure that there is also not a lot of Vega difference between the 2 months. So when I'm talking about that, I've talked about, I don't want to use Booking as an example. Let me just pull one up. I'll do TLT because I don't know why it's the first thing that came to mind. So despite the fact that I have a bullish trade on in TLT, here we go. So, 90 days out, that's pretty good for the ones that we're buying. You can go a little bit further. The reason why I don't like to go that, 300 days out, those true to form leaps, is because, for one, it's not going to fit my rule for the width of the strikes, the debit paid for the width of the strikes rule, we're going to have to roll these short puts out several times in order to get it to, you know, make it worthwhile. But, you know, 90 plus to 150 some odd days out is a pretty good one. Let's just look at the April for right now. So I'm going to be looking at this one between that and the 36 days to expiration. All right. So what we want to make sure is over here in the Vega side that we don't have a lot of difference between this volatility coefficient and this volatility coefficient. And my rule here is with something like this, if it is basically, you know, around, let's just say if it's 2%, that's right there at a green light. You know, it can be 2 plus, you know, or slightly less than that, but somewhere around that 2%. If we're looking at it any more like 3 to 4%, you know, that's going to be your yellow light. And if we start looking at something that is 5% or greater, especially in this type of environment where, you know, last year in January, you wouldn't have found any of this working out. It would have all been pretty wide. But in this type of environment, we really want to stick to this rule because we really haven't seen volatility in quite some time. So in and around this, that's what we're looking for. Now, we are in an earnings, you know, season right now where we're really in the thick of it. And this 36 days to expiration is going to be holding a lot of earnings. So a lot of times what we're going to see here is, let me just pull something up and just see if it works out. Lulu is not going to work out, of course. Anybody know who's got earnings just around the corner? Let's just take a look at MGM, see if, so this is a situation where if we look at the two different volatilities here, where this Vega is 27, well, we go out here and see this one's 25. Well, this is likely saying there's an earnings right around in this area, all right? That's why there's volatility getting jammed up in here. It's not always the case, but if there is not an earnings going on in this February, within this February contract, and you see this kind of differential between them where the volatility here is greater than the volatility here, well, then that is a total green light, right? Because now we are looking at really something that is like a negative 2%, right? Differential. It's decreasing by 2%. So that means the volatility in these options we're going to be selling is higher than the options we are going to be buying. All right. So that's a good thing. That means we're getting paid a lot more for those options we're selling than the volatility we got to pay for in the options we're buying. So this is usually an odd case, but I'm pretty sure that that means that anytime you see that happening, go and double check and say, do they actually have the options having a, let's just take a look at it and see if MGM has that just around the corner. You can see Target does. I really want to short Target. So MGM has that earnings in that options expiration that we would be looking to sell. It's landing right there. So if you were bearish in it, I would probably wait for the earnings and having that volatility come out of the options. We're going to continuously see this option volatility increase in that contract we were selling, and that would actually hurt us. So although volatility is really high in that option right now, it's probably going to go back up to normalcy, which is going to be up and around here. So that would hurt us through the duration of this contract. So that's why I don't love selling this strategy well ahead of earnings, because that short put that I have put on is going to be hurt by that volatility. And although volatility does affect further duration options more, we're not going to see the options volatility expand as fast in that back month as it is in the one that is having that binary event going on right now. All right. So stay away from that, especially well ahead of the earnings event. All right. Does that make sense so far? So you will see that happen sometimes. It can be a good thing, but just be aware, you know, anytime something looks really great, there's also a probably a glaring problem with that. All right, we've talked about this. Durations, most people will say we're looking at, you know, if you go online, they're going to say you're going to be looking at these leaps that are 1.5 to 2 years out. All right, those are for the leaps. And, you know, I kind of cancel that out. I'm usually going to be looking at something that is, like I said, I think the green light for this is basically we're looking at about 90 to, you know, 150 days to expiration. And when we pull up the platform, like I said, I'm going to be showing you guys how we build this strategy out to make all of these levers and pulleys come together, like with the strikes. The strikes in that 75%, the width of the strikes is what we were talking about, right? We want 75, less than 75% there. That is going to be a lot more plausible or accessible with these days to expiration setups. All right, so that's what we're going to be looking for there. All right, and one of the reasons why I want to do that, I want to get out here. These are the at the monies. Now we can argue that this diagram of theta isn't really a great representation of the options that we're going to be using, but what I want you to see here is that the ones that are closest to expiration, these are where we're going to be selling our short put, right? We want that theta decay because we want this short put that we got a credit. We're going to get a credit for that. We want that credit to equal to 0. We want to be able to see that credit go all the way down. And then, you know, we'll be able to roll that out once it gets very close to that. And then when we're buying our put, we're buying a put way out here. So we won't be seeing as much theta decay happening, and that's going to help out the strategy as well. So a lot of things that are going on here where we have different volatility components, different expiration cycles. May seem a little bit confusing, but this hopefully will help set that up a little bit better. We want to get out here right around that 90 days because the further this goes out, it kind of flat lines a little bit better. And then this one that we're short in here gets all that theta decay. And we want this put to go to 0 as fast as we can, right? So that's why we're picking those different expirations on that. All right, the right environment, really, this has the best case scenario, the middle of the road, implied volatility percent of around, you know, 30. Middle ones, usually I have better strategies for implied volatility percent that's lower than 30 or higher than basically 50, but right in the middle, probably where we're going to look for ETFs, maybe less than, you know, right around that 15% here. But remember, our main concern with environment, and when I'm talking about implied volatility here, I don't want to have a big discrepancy between those two months, those two expiration cycles, all right? And when I'm talking about implied volatility percent, we can pull up a chart, and basically what implied volatility percent tells us is where XYZ's implied volatility, because they all are created differently. If we're looking at eBay right now, it's at 30. You know, we can look at Tesla and say Tesla, we can see Tesla never gets to 30, all right? So that's why you don't want to just look at implied volatility. When I'm talking about implied volatility percent for the, you know, implied volatility percent, it's different. It's not implied volatility, although it, you know, can be shown as a percent. What we want to do is take where the current implied volatility is, and we come up with a mathematical equation. And basically what we do is we find, I'm going to have to find the highs and the lows here. But if we find the high, it's 85, and the low, let's call it 36. So what we do is we have a fraction here, and we take the current IV and subtract that by the low IV. And when we get that sum, we divide it by the sum of the high IV minus the low IV, right? And we take those two sums and divide them by each other. So what we said was the current is like 72. It looks like 71.5. Let's just call it 72. The low, I think I said, was 36, right? And then we divide that sum by the high, which I believe, what did I say the high was? 81. Let's just say it was 81 minus 36, which is the low. All right. So now what we have here is, what is that? 36. 36 divided by 81 minus that is 45. So that basically puts us at somewhere, look at John David. I love having you in the class. He's got the math all, about 80%, let's call it. I'm going on his math. All right. So it's right around 80%. So that's in the higher realm of where we want to be. Now, one of those reasons is there's a earnings going on right there, but that's how we come up with implied volatility percent. So when I'm talking about this, we would kind of want it to be somewhere between 30 and 50% usually. That kind of also means there's likely not an earnings going on as well. So a lot of these things I'm trying to help you out with and have these different rules because I want you to avoid those mistakes. If one light bulb doesn't go off, well, this is another reason for the light bulb to go off because it's not fitting some of these rules. And the reason why it's not fitting some of these rules is because there's something wanky going on. All right. And this will help you avoid those pitfalls, like you can learn how to do this strategy. I'm not going to lie, you guys, online, literally, you can go online and find out how to do this strategy. But one thing is they aren't going to tell you, all of these different pitfalls to avoid because they don't understand it as well as what we're going to be talking about in these webinars. We want the theta of the short leg to drop to zero. Well, we want the premium in that that short leg really to go to zero. It's not always, if we had the Tesla and we had those short puts on here, like let's say for instance our short puts were here and they don't go to zero, but the trade comes down there. Well, that put isn't going to go to zero. These long puts way up here that we got that are deep in the money, right, are going to increase much faster than these puts are going to increase also. So keep that in mind. Yes, those short puts could go into the money, but remember, because the deltas on this, we're doing like the delta of about an 84, and when we're doing these deltas, we're looking at about 25, maybe somewhere between 25 and 35 delta. So these aren't going to increase as fast as these are. All right, so our in the money ones are going to increase much faster. All right, that makes sense. So the right environment, an IV percent of 30 to 50ish. Just make sure also that we are looking at the Vega coefficient on the option montage. We want less than a 2% difference, right? Difference, all right? All right. And just know your exit strategy before entering the trade. For one, if you have a target, like you got your Fibonacci's and lines are going right here and it's trading up like this, and you think, okay, I think it's going to break down and, this is my target. That's probably where your short puts are going to be too. Just know I'm getting out as soon as those short puts get breached. All right. That way you don't have to worry about the forced assignment. All right. Also on the upside, know your exit on the upside. If it breaks above that Fibonacci or it breaks, we got lower highs and lower lows. Well, if it breaks above like that, now we've got a higher high. And usually that means we've broken that down pattern, right? You know, if you have a trend channel and it breaks above this, that could be an indication that you're out. Whatever your rules are, usually on trading patterns or Ichimoku clouds or Fibonacci's, all of that is the same. If you watch Steve Primo, you know, he has a lot of rules on where you get out of these different setups and stuff like that. As soon as that setup is broken, get out, all right? As soon as it breaks out of the trend channel, and that's what you usually follow, get out, all right? Everybody's risk parameters are different. I don't have a rule on, like, you know, all right, we're looking for a 10% correction on this, or, you know, you're out on a 3% bounce or something. I don't have that. I usually look at like Fibonacci and market profile and stuff like that. So those are what I use for my indicators. And when those rules get broken, that's when I get out, all right? But write it down so that if it does breach that, then you are more likely to get out when it's breached that rule, all right? So make sure you do that. Yes, you do have to know when to exit, Rick. I thought you were going to say something. Oh, that we're not done yet. I thought you were going to say something about, anyway, let's pull this up. So this is usually where I talk to you guys, throw it out in the questions box. Rick got me throwing off my game. Throw it in the questions box. Some stocks that you guys might be bearish on. If you have a bearish assumption in something, we'll take a look at it. I might as well take a look at the TLT trade since I had it up. We know that it fits a few of those rules. All right, TLT is a $100 stock. Is it the right underlying? Move the decimal 3 ticks to the left. We're looking at about 14 cents. We'd want to come down here and look at these options that are 36 days to expiration, 35 days closest to that. Make sure that it fits that rule. We can easily see it does. So next thing we want to do also is look at the strikes. Make sure that our differential is the 90 days out. We can see that that is less than that 2%. All right, so that's good. Now what we're going to be doing is looking for the strike, picking the right strikes. I talked about this a little bit, but we're going to be looking for the one that is about an 84 delta in the money. All right, so that's something I didn't write down for picking the right strikes, I don't think. But on this further duration, we're looking at the 84 delta. So we're going to go in here, and I'm going to go a little bit wider. We'll check it out. So I'm going to buy that one, right? So that's about the 84 delta. Something else to look at. We want to make sure the only way to get our break even as close to where the underlying is trading is the payoff of all the extrinsic value, all right? Now, options that are in the money have intrinsic value and extrinsic value. The intrinsic value is what this option is worth. Intrinsic value would be that this option 149 put is equal to, you know, $10 really, $10 even, all right? Because 149 minus $10 puts me right to where the underlying is trading. You know, it's $9.91 really is what this is worth, all right? So, you know, $9.91 means that we have about 50 some cents to pay off. That's the extrinsic value. One quick trader hack, you know, the easiest way to find the extrinsic value is kind of look at the corresponding calls, or, you know, if you were looking in the money calls, you look at the corresponding puts. That's very close for government work to come up with what your extrinsic value is rather than going through all the math, right? Okay, well, 149 to 39 is $9.91, $9.91, you know, and out of $10 and, you know, 50 cents is, you know, that's a lot of math to be doing. Why not just go like this? Bing, I just look over here. All right, it's about 56 cents, maybe a little bit more, but I don't care about a nickel or something like that usually. So that's how we floor trader hack. Look at the corresponding call of an in the money put. That's your extrinsic value. All right, so pretty quick and pretty easy. So when I go down here, what do? Options that are out of the money are all extrinsic value. There's no intrinsic value. These are worthless, right? The market isn't there yet. They're only worth something once they go in the money. So all of this is extrinsic value. Well, what do I want to do? I want to pay off that extrinsic value. So by selling the ones that are about 60 some odd cents, gets me that extrinsic value, or at least very close to it. One thing we need to do here is look at our break even to see, make sure that's in line. So what do we say? The in the money put, 149 minus $9.89. What is that? That's going to be very close to where 149 minus the $9.89 equals 139.11. Look at that. Right there at the break even. That means I'm buying these puts for their value. All right. Next thing we need to do is we need to find out if it is within that realm of the rule I was talking about, with less than 75% paying $8.90 or $8.89. Make sure we're paying less than 75% the width of the strikes. And the width of the strikes here we're looking at is, what is that, 13. All right, so 76, that would be about a yellow light, all right? It's very close. You're gonna have to make your assumption. One of the thing is, I've got a pretty nice wide spread. That looks pretty good. We might want to play around with the strikes here a little bit. So maybe I have to go to the 148s. Let me just, come on, do that. Give me a 148s. 148s, how much am I paying? It didn't come off very much. Doesn't make sense. $9 divided by a tighter spread. $9 divided by 8 and 4 is 12. 75, that makes it right on the nose there. So that makes that work. All right. Actually, if we look at this, the way I built that out, if I go to 148 puts and minus that $9, let's call it, minus the $9, it's going to put me a little bit below, right? So although I am meeting that one rule, I might actually opt for the 149s in this case. You know, yes, it does make it 1 percentage point wide out of there, but the other thing is I've got a little bit wider spread now too. And it puts me like right in there at the break even. So my break even isn't below where the underlying is. Okay. So those are, it's a yellow light, but this is a little bit wider also. Somebody wants to see the analyze on this trade. So let's check out the analyze, and it's got my other stuff in there. So let's get rid of that, all that stuff. And that's your analyze, right? So we have, and you know what, if we pull this in, we'll see that we have a limited risk to the upside. It does do a little bit of a sloping to the upside, but that is, we have limited risk to the upside, all right? And the purple is if you basically did a collar around the underlying. So we have no risk above 149. It's going to be that debit paid. And the beauty in this, when we're looking at the trade again, so remember, when we want, if the underlying starts trading and these 136 puts never get hit and expire worthless, well, then we'll be able to roll out to the March, all right? We'll buy those puts in, and maybe we'll be able to go out here and sell the 130s or the 131s, all right? Collect another 50 cents or so, all right? Now our spread's gotten $5 wider. We lowered our basis of what we paid by this trade. We originally paid $9.80. Well, if we're able to collect another 41 cents, well, or 45 cents, well, we've lowered what we paid by another 45 cents. So now we're only in this for $9.35, something like that, okay? So the idea with this trade is to continuously try and roll out, especially if it doesn't make that sharp move down, roll out those puts. See if you can roll them out and away, all right? Out and make it wider. You want to make sure that, you might have to go out and sell these 136 puts again for, 50 cents, if these all decayed and it didn't really go anywhere. That's fine. You're still lowering your basis by, 45 cents. You got the same strike. You're, paying less than the width threshold that we were looking at. One thing I want to make sure, and sometimes you might have to tighten it up a little bit. Maybe you go in and you have to sell the 137s. Make sure that when you're doing that and lowering your cost basis, that this spread, what you've total paid, isn't more than the width of the spread, right? That doesn't make sense, right? If I had to tighten this up a little bit and sell the 139s, well, now, or the 140s or something like that, and all of a sudden my total debit paid is more than the width of the spread, then that doesn't make sense, okay? It means this strategy isn't going in your direction, all right? And you're trying too hard. It's better to just kind of, all right, well, the debit I paid, that's what I know I lost. Maybe it's breaking my threshold to the upside. It's breaking above this. We've got lower highs and lower lows. Maybe it's breaking above too much, all right? So we wouldn't want to do that. Somebody, I think, had XLK out there, so let's look at that. We can do this on ETFs. We talked about that. Maybe you expect technology. It's probably, in my eyes, going to be one to go, but appreciate that. Thank you for the kind words, Rick. One of the things, XLK, we can look at, we're going to look at less than $100 stock. So these need to be 10 cents wide or less. You can see over here out of the monies, they've gotten a little bit wide here. It's probably because it's outside of open market operations, but because it's an ETF, we can likely see that it's going to happen. So let's look at the June, and we're going to look at the 84 delta. So let's look at the 106s. We're going to buy those, go down and cut across our little hack. These have gotten all over the place. So we probably have to figure it out. So we got about $10 and $9.45 of intrinsic. So these are really wide. So $9, somewhere in between here is going to be, so we just got to pay off about $1 or something here, about $1.50. So go down and look at the in the money or the puts that are about $1 something. These are too wide. It's just not really going to work out. It's going to give me middle market on these. So it's really wide. Let's not use that one. These markets are too wide. It's not going to work out. So let's just say that doesn't fit. So let's look at U.S. Bank. U.S. Bank just took a nosedive off of their earnings. They missed. Most other banks are beating on it, and it could cause it to go up. But they missed on this one. So let's take a look at it and go to the June. Go to the any monies. So the 60s. One delta is close enough. 80. You're never really going to always get the exact one. So then we're going to look at how much we got to pay off. About 50 cents. Probably going to have to go a little bit closer on this one and sell off a little bit more. I don't know if I'd want to go that tight. You know what I would probably do is risk not getting all of it on this. This might be one of those ones where I just got to roll it out. further out you go, I'm outside, I'm at that 150 mark. The likelihood of being able to pay off all of the extrinsic value on the first month is pretty low. So this is going to be one of those examples where I have to make sure that I'm going to be diligent and mechanical in rolling these out. Yes, you can use the weeklies, rolling out through the weeklies if you want, to make sure you get that credit. One thing we want to look at here is 60 minus the $5.22 puts our break even at 154.80 something. So we're getting involved in this just below where the underlying is currently traded. We got to know that going into it. So our break even is lower. We got to make up some ground here on this trade. Does everything else fit to make sure that we only have that one yellow light, that we're not getting too much, paying too much for this? 522, the width of this is $7.50. So divided by $7.50. Let's see if this comes out. So 70. So that's a green light, right? So the one thing we're not paying all the extrinsic value out. All right. So we would need to make sure we stay diligent, rolled it out in time, maybe even use the weeklies where we say, where's a strike that we can be comfortable with to pay off some of that extrinsic, and it might be these. So let's say buy those and get out of those and say, let's try to do the 3.5s. So we're paying $5 for this, right, on a $6.50. So 5 divided by $6.50, 76. So you'd have to weigh, that's a yellow light in my eyes. So I'd probably go with the yellow light of a little bit wider spread, higher profit potential, but I got to make up a little ground. All right, Ulta is another one. So let's look at Ulta. Let's delete that. 36 days over $100 stock. So 3 ticks to the left. We're looking at about 27, 28 cents. Ulta usually fits this rule, you guys. It's, we're looking at 40 cents here. Again, if it were like this during open market operations where it's just slightly outside of my rule, it's 30 cents here and there. Look at that. That's a yellow light. Okay. If we got too many yellow lights, we move on. So that fits that rule. So let's go out about 150 days to expiration. We can look at the chart and say, all right, maybe we expect it to come back down to, 54 area. I'm just trying to get my ins and outs or whatever. So 84 delta, we're going to be buying in the money. What do? Flip over here. We got to pay off about $5.40 or something like that to get to the extrinsic value all paid off. We got that one. It's a 35 delta. Actually, you know what? When I was saying what happened there, when I was saying the 20 delta, it's really going to be about a 20 to a 30 delta, to be honest. So I may have misspoke earlier on, gotten a little ahead of myself there. All right, so we're paying $65 on this one. So we're going to make sure we got the width of the spreads here. So 65.20, right? 65.20 divided by the width here. It's pretty wide. So we've got about a $75 wide one divided by 75, 86. It's pretty steep. One thing I forgot to check on this was, does it fit the rule on the difference here? Look, so that's why one of the reasons, if you get that red light, especially that much, we're looking at 86, 87% the width. The reason why is because, look, I'm not getting paid for my options that I'm selling. I'm got a 26% volatility there and a 35 there. So that automatically is almost, 10 percentage point increase. I'm paying a lot in volatility way out here. So had I gone through this correctly and gone through my checklist, I would have said the right environment, you know, that's way off the charts. Way too much of an increase. That means I'm paying a lot of volatility, and that's usually going to make sure we would have known right off the bat that this probably is not going to work, okay? Because you're paying too much volatility. That means you have to make it too tight of a spread, right? So I'm paying a lot of volatility for these in the monies. It means that these ones that I'm trying to sell, I'm getting too close to where the underlying's trading. I'm really too deep in the money out there because of the volatility, and I'm way too tight here. So, you know, those rules I'm coming up with will kind of help you avoid, you know, making that mistake, you know, of building it out and knowing that it wouldn't work out. You know, if you go online and figure out how to do a poor man's covered put, those guys are not going to tell you this. They're going to say you buy that in the money leap and then you sell an out of the money put and you're good to go. You're on your way. It's over. It's done. No, it's not. If you see something like this happen and you have a long-term bearish assumption in Alta, there's better strategies out there that I talk about. All right. Maybe it's going to be the synthetic short. You know, we've talked about implementing that in this. Something I also want to talk about is, especially in a market that is, you know, bullish right now, we don't want to allocate a ton of our portfolio to overall shorts, right? Unless you are an absolute monster contrarian, which some may say I am. But, you know, I wouldn't overextend this. Sorry, you guys. I have a child trying to get in the door here, and the dogs are the doorbell. And I'm not going to answer it. So, all right. So, appreciate it. Very good session. Thank you very much. I see one of your other things there, Rick. I'll get to that in just a second. So, what was I saying? So, yeah, basically, you know, all of these rules are basically set up to make sure you avoid pitfalls, all right? So if something like this were happening, you know, we would look at a different option strategy. Maybe the synthetic short would be a better one for this because we can neutralize volatility and things of that nature. So make sure you check out that one, implementing that. But don't overdo it on the shorts in, you know, a bullish trending market. You know, we do want some in there sprinkled in because why? We need some hedges in our portfolio. And sometimes it's good to lose on those, despite the fact that, you know, we've got a bullish move, right? We have to remember that we need to have some hedges in there to make sure we're protected. All right. Good option strategies are analogies to winning chessboard strategies. Absolutely. You know when to press and when to retreat. Yes, regroup and without losing valuable playing pieces. Absolutely, Rick. You're right. Sometimes you throw one of those out there, a pawn or something like that, because you're hedging a different move down the road, all right? So you always want to be ahead of the game. You want to sprinkle a couple of these in there. Even if you're bullish, try and find something that is maybe in a bearish market because when that correction happens, it is hedging your portfolio. Very good analogy. Thank you very much, Rick. Awesome webinar. I like how you show this strategy and rules, which can help us reduce risk. Thank you, Alexander. I appreciate that. Well, we are at that time where I throw out the offer here, you guys. This is the link up here. I'm going to throw out a link in the chat window, you guys. We've been going back and forth in the questions box. The chat window has the hot link here for this. This is a new offer. Nobody's seen it. First time we've offered it. If you're watching this on tape delay, you're going to have to punch this into your URL, but the hot link's over there in the chat window. So this has the hacks. A lot of those hacks I just showed you, right? There's a lot of hacks in here. I showed you one, how to figure out extrinsic value very quickly. I've also got a lot of them on, you know, Delta and what that tells you. Also, some other things with Vega and just ways to streamline your process, right? We can spend all day long punching stuff into a calculator and brain draining ourselves, trying to figure stuff out. We have hacks. It was the fastest person to come up with a quote was the person that got the trade. And we've come up with a lot of little things that will help speed up your daily process. And, you'll just have to glance over, what's extrinsic value? Okay, well, there it is. It's very easy. And trading with volatility crush. This is one of my favorite things to do, is trading volatility crush. You guys know one of the most important things to understand with options, you guys, is volatility. You need to know that in and out like the back of your hand, to be honest. It is the thing that is going to make or break your options career, all right? So know that, because the only real way to increase alpha in your portfolio is through options, okay? Everything else is, flipping coins and stuff like that. When you can shift the probabilities in your favor, that's creating alpha. And that's what we talk about in this Volatility Crush course. And now we're giving you guys all of these extra ones where these are different courses as well. Like this will take you through the end of time, basically. And breaking it down for $297. We're doing this because we're trying to get people, involved in this. We want to get you guys signed up. We're doing the Wealth Summit 365. So check that out as well. I've been putting stuff out on social media about that. That's a great thing coming up that you need to check out. If you guys have any questions, reach out to us at 310-599-6677 or email me at trading@protraderstrategies.com. All right. If any answers, this is a great deal. This is one of the best offers we've had. So make sure you guys take advantage of that. If you guys learned anything at all, you like the way that I teach, this is something you guys should not pass up. And we're only offering it for a limited time. And so take advantage of that. All right. Also, I want to thank you guys all for watching this webinar. Later webinars, I'll be drilling down on different option components when and where I find those appropriate. Again, here's that link. You're going to have to tape delay. It's over there in the chat window for live guys. And again, our number 310-598-6677 and trading@protraderstrategies.com is how you're going to get a hold of me. All right. I'll flip it back to this previous one. If you guys have any more questions, I can answer those as well. But seriously, if you guys, I teach a little bit different than everybody else. Yes, you can go on TV and watch those guys on mainstream media talk about how to trade. But to be honest, those guys are not giving you very good option strategies for the environment that they're trading. They may have the right directionality and all of that stuff. I don't care about that, about your directional assumption. I just don't agree with the option strategies they're touting for those specific environments, to be honest. All right. That's all I got. Thank you guys all for participating and hope you have a great one. If you can't take that, take it easy. Take care. Thank you all for all the kind words. Have a good one.